All right, testing, 1, 2, 3. Testing, 1, 2, 3. 1, 2, 3, 4, 5. Ni hao ma. Damn. The camera adds 10 pounds of fat and gray hair. And of course, my head must be really small. I have a very small head, but a very large addiction. All right, I gotta click something. Oh, we might have liftoff behind me. Hang on. This is dragging. Let's do something different. Too many things going on. I'm not a multitasker. All right. Welcome to forex.today. What day is it? Is it Tuesday? I don't even know, honestly. Hello. Michael, it's never bright and sunny in Michigan. Unless you're in the UP or something. Hey, good morning, everybody. Welcome to forex.today. My name is Wayne McDonald. I'm the Chief FX Market Strategist for TradersWay.com. It's in our best interest to make you a success. That's just flat out why I'm here. If you're a success, if you develop real skills, long-lasting skills for you to compete in the foreign exchange market, then you will trade every day, every week, every month, every quarter, year after year after year after year. And as a broker, if you pull the trigger, we earn money. I mean, that's how it is, right? So it's in our best interest for you to survive as long as possible. Now, many of you guys are amateurs, and so I'm here to teach and to share my experience of doing this for a very, very long time. And while doing so, earn your respect and your loyalty so that when you do feel ready to trade money in the foreign exchange market, maybe, just maybe, you'll choose Traders Way as your prime brokerage. And as you get better, as your account size grows, or maybe you attract clients, not only do we want to be your broker, we want to be your prime broker, but whatever. Now, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. We stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. My name is Wayne McDonald. I am the Chief FX Market Strategist for Traders Way. We do these sessions every day, 7:30 in the morning, Monday through Friday. And I encourage you to ask questions, to be involved, to participate and interact. So I think, yeah, I think most people have sound, right? Oops, that's not what I wanted to do. There we go. All right. G'day, mate. So my main PC is struggling again. So I'm on the backup laptop. Wow, that coffee went down the wrong pipe. All right. So let's giddy up. This is our friend the Beast. I guess the Beast is never your friend, huh? All right, so take a look at the Beast. What has happened so far in the week? We had a gap up. Right, as you see here. Roll reversal. Okay. And hit a logical target for the week. Pretty logical. WM4 is the conservative target. The aggressive target is a little higher up. But there is a monthly resistance pivot in there. Notice that there's no what I would call swing trade setup. Okay. The swing trade setup would have been, well, way back here. The only problem is that was last week, not this week's. So that pivot didn't exist. But in that case, what do you play? What tools do you use in a trending market? Things like rolled reversals, that's called price action. You could use Fibonacci. And then, of course, buying in the moving averages. Michael says, like, Georgia's not hot and muggy. Well, you know, Georgia gets hot, but I think it's got a bad rap. Atlanta rarely hits 100 degrees, so for most places, that's not that hot. You want hot, shoot, even Chicago gets hotter than that. And then, yeah, it gets humid, but it's not like swampy. Once again, you want humid, go to Chicago. And you said muggy, right? Chicago gets muggy in the summer, doesn't it? Like you get outside and you're just like, I can't breathe. I can't breathe. I don't think Georgia gets like that. It cools down at night. The elevation's relatively high in Atlanta, and if you go north of Atlanta, it gets much higher. You want humid, go to Austin, Texas. Oh my gosh, 110 degrees and 90% humidity. So actually, I think Atlanta gets a bad rap. I don't find it that hot. I don't find it that humid. No, it is humid. It is hot. But it's like 94 degrees every single day, day after day after day, but never 100. Actually, so I kind of like it here anyways. So looking at this down into the moving averages and gone. That's the only thing you can do. And you got to be cautious because you know it's overbought. As a swing trader, you know it's overbought. But remember, it's overbought because everybody's buying it. Well, Peter, if you took the swing trading course, you'd know that there's just no swing setup. So there is no swing. That's all. But it doesn't mean there's no trade. There's just not that particular setup. So that's the beast. Oil. So remember, we had what was it? $44.30 or something is the predicted bottom. Amazing that that's held, huh? It's remarkable, isn't it? I mean, I think it is. I think analysis is amazing where we're trying to accurately predict the future day after day after day after day. It's amazing to think like 3-4 weeks ago, we're like, yeah, 55 is too much, needs to come back down to 54. In fact, it's, 44. In fact, 44.30, you know, it dropped to 43.80 and then stopped and then bounced back up within seconds of hitting that target. I mean, I love it, man. It's not that easy predicting the future, is it? So, you know, you got to feel good when you're reasonably accurate. Love it. You can see even back in March, you see, back in March, I have this 45 area as a level of importance. And I would consider this spike and then pop right back in a valid test of that level. Okay. So you could sell gold here, or sorry, oil here. You see that? You could sell oil here. Definitely could. And your target would be, you know, 41.5. Okay. It'd have to move like right now. Peter, just go back into the previous video. I mean, I don't know. The old analysis, you know, and of course that was done on a different computer as well. But just think of it this way. We had whatever it was, I think it was like a monthly and a weekly pivot cluster around 55. Right? Psychological level. I mean, look at this. Look at the top. Right? I mean, look, it wasn't complicated. When you look at this, you're just like, look, this 55 area is toppage. Okay? And then, right? And then, you know, the target at 45, I think had to do with a monthly pivot last month, overlapping a monthly pivot this month. Okay? As far as target's concerned, right? Which predicted a break of this level, but maybe a pause at this level. But, you know, that's so last week or last month, who cares? Okay. This is this USD kitty cat. What do you see here? What future do you predict? Yes, I'll take both Ryan and Charles's answers. The double top produced right around 38, maybe a slight higher. Okay, the pieces of this have to do with the 55's in control. weekly M2 support up to the weekly monthly pivot cluster, which happens to be monthly R1. But we already know it's going to double top because of the 55. So up into this area and collapse, which is predicting either US dollar strength or Canadian dollar strength. So how about bad inventory data tomorrow? And then an OPEC announcement on Thursday in response to the bad inventory data. Okay. Plus, aren't we expecting oil inventories to start drawing down in 3 weeks? It's part of predicting the future, is knowing what the future is going to be. Well, to be fair, Ryan, that was done 10 years ago, and the last most recent 10 years would not prove it, would not agree. So it really comes down to normal. So there, I would say we're vulnerable to getting that wrong because frackers are not following a typical cycle, right? But it's still something to prepare for, I think. But I wouldn't blindly bet the farm like I normally do, right? All right, so anyways, so yeah, that's what I saw. The 55 WM2 cluster predicts double top and drop. Okay. Bears that sold the Euro USD on the open are nearing their target. So you trade it either as a swing, head and shoulders, blah, 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 blah. Now here's what people often ask me. Wayne, how would you know it was going down? Feels really after the fact, right? Like, Wayne, how did you know it was going down? And I don't. And that's where amateurs make mistakes. You have, excuse me, you have to already be a bear, or you already have to be a bull. So a bull would have tried to buy it off this weekly central pivot. And it failed. That's it. A bear would have sold it off the M3. And if they did, they're making money. That's it. So it's not that you know, it's that you did what you were supposed to do, and the market either agreed with you or it didn't agree with you. It's not that you're right or wrong, it's whether the market agrees. And when you're looking for answers here, you're going to get yourself into trouble. Because by the time you see the answer, it's already happened. So I hope that's a revelation. And as euro dollar went up the last several weeks, right? I think I was clear that I'm still a bear. And a bear should do what a bear is supposed to do. So this, you see this big giant gap? What was a bear supposed to do in here? Nothing. And what did I tell you during this period? That I didn't even want to look at it. Why would I want to look at it? There's nothing to do. I'm a bear. Right? And here you could have sold, I suppose, but it's not bearish because we've never made a lower low, right? And then in here, it is bearish. The reason it's bearish is it's in a bearish swing setup. Now, you could have easily been a bull along the way. Okay. That's fine too, but there was the only aggressive opportunity was to buy the gap off the weekly central. Perfectly valid setup. Exactly what you were supposed to do if you're an aggressive bull in an uptrend. There was probably a 21 holding you up. You did everything right, and for an hour or two you were profitable. Actually, for several hours you were profitable until it got to where the bears are supposed to sell and the bears sold. It was also 110, which is, so obvious even a blind man can see it, right? And what do you think? Do you think the media got too excited about the French election? Was it really needed? Like, and I look at this, I'm like, really? I was asked to speak on a panel. I wasn't even interested. I didn't even have an opinion. I'm like, it's France. Who cares? Now what? Am I going to get all excited about the Italian election that they haven't even called yet? Italy's going to surprise everyone and do snap elections in the fall. Great. I guess I better get emotionally prepared for that. Well, I hope you appreciate that I never got too excited about it at all. And that's really what a trader should be like, right? I thought Berlusconi is going to bring in a second party or something, but I don't know. I'm not part of Italian politics. All right. But like I was saying, I hope you appreciate that, when we get together, it's trader commentary. It's what, that we don't get all hyped up, that we can cut through all that. Or at least it's our job to cut through all that, right? Let's see if I have a different template on this PC pivot clusters. Good. Same thing. No real swing. So you got to use the EMAs if you're a bull. But you still have to use the same resistance. You just don't really have supportive. So you're buying it overbought. You got to be careful in those situations. And, the market, I would say, looks like they most likely will keep Kiwi yen under 80, which means when you get to about 79 and some change, 79.24, that should probably be the top, which is then predicting either Kiwi weakness or yen strength. Okay. Not an easy trade. But you can see we have printed a low, right? Higher high, higher low, higher high, higher low, higher high. So maybe just catch the next dip if that's what you want. It'll be next week, of course. Or maybe even down on Friday. Notice that there's a Friday buy, there's a Friday buy, there's a Friday buy. Okay? Right? You see that pattern? Charles, do now. So yeah, so I don't know, put it on your to-do list, right? But then the problem is you got to hold it over the weekend, right? We have BOJ news tomorrow night, I think. Okay, so that can change all of that pretty quickly. So yields keep. Oh, I'm sorry. Yeah, I forgot. I think this laptop has a bug where the watermarks are wrong. Sorry. All right. So here we got the USD yen. It was a buy at 110, if you remember, or 109. I think we bought it at, right? Now we're at 114. Oy vey. And it's really interesting because we have a Fed meeting in there, and they were not incredibly excited. They didn't raise interest rates. Yet the dollar keeps getting strong. And first of all, that's what I want it to do. So you're welcome. But it's still kind of strange, right? Because the data really isn't that great, but there's nothing else really to do with your money. Wow. And interest rates in the United States keep going up. The 10-year T-note is not skyrocketing, but the yield is not falling either. 2.3, 2.4, right? Well, 2.31, 2.32, 2.33, 2.34, 2.35. That favors the dollar. Now, let's get a little esoteric here. You may be watching the VIX. The VIX has hit the lowest number since the beginning of the financial crisis. A low VIX means low volatility. Low volatility means complacentness. The VIX is measured by the number of options on S&P 500 futures purchased as a hedge. So imagine it as insurance. If you're a little bit cautious, a little bit concerned about the market, a little bit concerned about your money, you make an investment, and then you spend a little extra money on insuring it. Sort of like buying a house. It may be the biggest purchase that you make. Let's say it's $1 million. Well, you don't want your house to burn down. It's a lot of money. That's a lot of risk. So you might pay for some insurance, or if it floods, or if there's a tornado, right? That kind of thing. Hailstorms. So it's insured. It costs you some money, but it protects your investment. Well, what if you bought $1 million of S&P 500? Or what if you bought $1 billion worth of S&P 500 futures? And of course, you're buying them, so you're worried that they're going to fall. So you offset that risk a little bit by using the options market, so that if the S&P 500 falls, you'll earn some money on your options trade, which costs you hardly anything relative to your cash position, and it just protects your investment. Well, the VIX is a measure of how many of these insurance policies, if you want to look at it that way, have been purchased. Now, would you buy flood insurance if you lived at the top of a mountain? Or would you buy flood insurance if you lived in the middle of the desert and it hasn't rained in 100 years? Probably not, right? Because you're saying, well, it hasn't rained in 100 years. Why would I waste money on insurance? Yeah, no, of course, but a few drops could be bad. But, just take it as sort of the basic stuff, right? So right now, the number of options purchased by market participants to insure their investment into the S&P 500 is really, 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 really low. Another way of saying it is people are so confident in their investments that they're not buying insurance. They're naked. So the concern here is if anything spooks the market is vulnerable because they're not insured. So like if the market dropped, let's say 4% next week, bad week, 4 or 5 days in a row of not up, right? Well, look, if you were insured, you're like, oh, it's not a big deal. I don't need to get out of my cash position because my option's making money. And since you're bullish, you think it's going to go back up anyways. So, you're hoping to stay in as long as you can, because if it goes back up, then your option will expire worthless, but it didn't cost you much money anyways, and just keeps you in the game a little longer so you can sleep at night, right? Well, in this case, if the stock market drops 4% and the entire market is uninsured, they don't have that comfort level. And the concern is if the market dropped 4%, then it can drop 10%. Because there's no buffer zone. So instead of being insured and making money on your option play, you just simply get out, sell, which drops market further, which gets the other guy to sell, which drops market further, which gets another guy to sell, and then sell, and it becomes an avalanche. Now, I wouldn't say end of the world avalanche, but there's some vulnerability in the market. Most likely dumb money, because what a dumb thing to do. So what may happen is we'll have a pullback. It may be a fairly significant pullback, but it'd be something to do right before summer, wouldn't it? So I'd say between now and the Fed meeting, we'll have a reasonable decline in the stock market and then sideways action all summer. And then we buy it all back in September, or really October. What do you think? Yeah, well, the stock market, yeah. Which means VIX would go back up to more normal levels. Well, in fact, spike. So the yen would get strong in a scenario like that, and so would the Swiss franc. 1 second, give me 30 seconds. So you know me, it's not a doomsday scenario. It's just a word of caution. So you want to look for things like being at the top of the monthly pivots, because that may be the top of the month. You see what I mean? So for example, if the stock market dropped today because of the VIX, that means foreigners invested in the US stock market will cash out, bring their money home. That means the dollar would weaken. Also, typically, if the stock market comes down in a risk-off scenario, the yen would get strong. So that means the USD yen, most likely, because we don't know, but most likely this pair would come down. We're also near the weekly and monthly predicted top at 114. Not, you know, I mean, does one predict the other? But that would make a ton of sense here, because according to technical analysis, that's exactly what's supposed to happen. It's Tuesday and we're nearing the projected top for the week. What is supposed to happen in a scenario like that? Okay. Yeah, and if you like buying gold, see, I've already done all this work, right? I've already predicted the bottom having been hit, or near, you know, the conservative target anyways, has already been hit for gold, and that it shouldn't go any farther than 217. What, or sorry, 217. 1217. Again, old analysis, we already did that. That's so 2 weeks ago, 3 weeks ago. So what if? So then you ask yourself, well, what if that is the bottom? What kind of scenario would make gold go up? Now, Bill says gold can go lower. Yeah, I'm not saying it can't. I'm just using technical analysis. Okay, so technical analysis tells me I need to be cautious. Okay. Okay, so let's say we focus analysis on the VIX. If you believe the VIX tells us that maybe, just maybe, there's vulnerability in the stock market. Okay? So if there is an event that spooks the herd, or the snowflake that lands on the top of the mountain that is just one snowflake too many, you know, using the avalanche idea. It just builds up, builds up, builds up. All of a sudden there's one snowflake too many. So what would happen to these pairs if such a cataclysmic event occurred? That's right. Swiss franc most likely would strengthen. Okay. Are we at or near resistance on these pairs? Yeah. And by the way, do you guys remember like a week ago? I think it was a week ago, might have been 2 weeks ago, that I brought up the pound Swissy. And I said, hey, I know we haven't been covering it much lately, but this is a good pair to trade. Maybe you should keep an eye on it. Look at the move since the middle of March, huh? Beautiful, huh? So I think you should have a contingency plan set. Okay? Because it's not like the stock market's going to do a flash crash. I mean, maybe it will, right? But most likely it'll be a week or two of bad stock market performance. So if you wake up in the morning and see it on your charts, or you're watching Bloomberg or CNBC, and you get a headline, you know, stock market falls 3% a day, you can say, oh, right? Or maybe it's something that you read tonight in the newspaper, tomorrow in the newspaper, and you say, oh, look, the stock market had a big bad day. Well, most likely it'll be followed up with several days, because we know the market is vulnerable. It's nice to be smart money, though, isn't it? To say, oh, I know they're naked on this, and they're regretting they didn't get out on the first day, right? Think of the guy that he's sitting there naked on his S&P 500 trade. The market drops 4% a day. Go! Okay? Okay? Remember, it's futures too, so he's leveraged. So he's praying to his futures god, please go up, please! Because he's the idiot that bought it recently, right? Because who gets in at the top? The dumb money, right? So he's going to do what a dumb investor does. Pray. Please go up, please go up, please. He'll probably even double down, buy some more futures. So on day two, it drops another 3%. Please, you know, but you can see that every day it's another opportunity to exit, right? Well, Charles, what I say is hope's not a strategy, but praying never hurts. So eventually, this person does what every other amateur trader does and hangs on way too late, takes a big loss, and then cashes out. probably around the bottom. So anyways, what I'm trying to say is you'll have several days. You'll probably have a full week and a half of, they'll say it's the longest stretch of down days in the S&P 500 since 1902, right? Whatever. And of course, the smart money will buy back then. Okay? And then they'll tell you it's because the Trump administration is getting closer to getting the tax rate to come down in the United States and make American corporations more competitive, blah, 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 blah. All right, great. There'll be a reason. So if you read all this and you got some time, you could say, well, what would the likely consequence be? And you might want to look at buying some Swiss franc. You might want to look at buying some Japanese yen. And maybe so those are your contingency plans. You notice everything is up except Aussie Swiss franc, huh? Euro stronger than Swissy. CAD stronger than Swissy. Pound is stronger than Swissy. Swissy stronger than Aussie. Aussie's the dog with fleas, right? So maybe that's the first one you short because it's already in a downtrend. Contrast that with the pound Swissy. Remember that? Pound Swissy's been up since March. Look at this dog. Look at this mutt. This dog with fleas, right? So this might be the one you want to drop. Or maybe it goes up because of gold going up. Oh, all right, well, pay attention. Do your analysis. But you might want to like look at some prices. Like a falling stock market can't be that good for the oil market. An oil market falling wouldn't be that good for CAD, so maybe it's this one. Are you at a reasonable level of resistance? If the stock market crashed today, would you sell CAD Swissy? Are you going to watch the stock market at 9:30? All right, so can you get kind of the message here? I'm trying to get you to think about what's next. I'm trying to get you to think about what hasn't happened yet. I'm trying to get you to think of the near future, a day, a week, even an hour ahead, right? Cause and effect. I think if you get good at cause and effect, you'll become more profitable as a trader. And I try to instill this even with my children. So the old time stories, there's quite a few examples over the history of my coaching. But one of them was like, I was reading in the newspaper, this was back when oil prices were high, that demand for corn was high to produce ethanol for gasoline. And this was now the second year of high oil prices. And it was the largest planting of corn, because the US government tracks this, okay? It was the largest planting of corn since World War II, when the government forced farmers to grow corn. So what happened was all the farmers decided, since corn prices were high because demand for ethanol was high, because prices for gasoline was high, that they would produce corn to get the high prices. Okay? You got it? So what is the cause and effect of this? Well, there's a bunch. First of all, if every idiot farmer planted corn, then they didn't plant something else. So there's two things that'll occur. There'll be too much corn and not enough something else. So that's what we talked about. Maybe it's time to sell corn and figure out what they didn't plant. Well, let's just say some wheat farmer decided to plant corn this season. Well, we're going to have a shortage of wheat. So you can buy wheat futures, sell corn futures. And by the way, both of those things worked that year. And I said, well, the other interesting thing about corn is it requires something like twice as much fertilizer as wheat. So you might as well buy Potash Corporation of Saskatchewan because demand for fertilizer is going to skyrocket, and they're the largest producer of fertilizer in the world. So you might as well buy Potash Corporation of Saskatchewan, and I think it's skyrocketed to an all-time high. And I said, well, and what about the wheat farmer that planted corn? He doesn't have the right equipment. He has a combine, but he doesn't have the right, attachments, so to speak. So he's going to need to go to John Deere and buy some attachments. So he's going to borrow some money from the bank and get the little thing that goes on the front of the combine so he can cut corn instead of wheat. So on and so forth, right? And it's simple logic. Bill says he's done his analysis on gold. Target is 1190 or 1180. Yeah. I'm not saying it ain't going down. I'm just saying, based on technical analysis, it needs to stop falling for a while. So, Bill, what if we hit that in June instead of May? All right, the technical analysis says the floor for May should be about 1217. And then there'll be a false rally for a while. And then potentially a resumption of downward movement in gold again. Yeah, well, all right, so Bill says he disagrees. I don't have an opinion. It's just what the charts tell me. It's not my opinion at all. Hell, I hate gold. I haven't, right? Whatever. It's not my thing. I think the world's a yield hog right now. But the analysis is the analysis. So if I was a concert pianist and someone gave me sheet music, I don't have an opinion, but the note is the note. The time is the time. And it should sound exactly right. So I'm just reading the notes, man. The note said, okay, 1200, 1180, sure, just not in May. Now, it could blow right through, and we could have the stock market, let's say, continues going up, or I don't know. I mean, it's just analysis. So sure, it could blow right through the monthly pivots, but it probably won't because it produces a certain probability. So, like, what are we looking at? Cat and Swiss. Okay, in this downward movement, what did this say last week? That even though it's been down for days, it probably won't fall any further than this pivot cluster, weekly S2, monthly S1. It's green, right? I think we can agree on all of that. This is green. On the 5th of May, it's the green zone, it's the monthly projected support, it's the weekly projected bottom. It can fall, and we do see times when price goes beyond the weekly pivots. Totally happens on a regular basis. But the probabilities of it going further, and significantly further too, are very low. It may fall further, it can fall further, except the probabilities of it falling further here in this scenario, based simply on technical analysis, are very low. Right? So that's not my opinion. Is it green? Yes. Then it'll probably go up, or at least stop falling, right? So I don't have an opinion. It's just that's what that is. So if I go back to gold and I see we're in a monthly green zone like that, to me it's not an opinion. It's like, there it is. So based on that, at the bare minimum, it probably won't fall further. It could. Okay? And if we get a fundamental reason for it, that's what would do it. But a technical reason probably won't fall further than $1,217 per ounce. Not an opinion, just probabilities. Yeah. Yeah, Bill's like time will tell. Yeah, so again, I'm not disagreeing with you. It's only timing. Robinson's Bulls will defend 1,200. Yeah, maybe, but I don't care about 1,200. Who cares about 1,200? I think they'll defend 1,000 like they did before, but so anyways, I'm not saying you're wrong, Bill. I just don't even have an opinion. I only have my facts, just the facts, ma'am. So anyways, I'm trying to get you to think ahead. What are you going to do if the stock market falls? Are you even going to watch the stock market? Do you even have a plan now? What would you do if the S&P 500 fell down? Yeah. So be ready for it, boy. Yeah, see, selling euro yen maybe at 124. If the stock market fell today, I might be into that. Selling USD yen at 114, I might be into that. But you know, and you know me, I want the yens to go up. I want the dollar to get strong. But there's an ebb and flow to everything, right? This looks like hesitation to me. Oh yeah, yeah. So you know, waiting. It's almost like it's waiting to fall, isn't it? It's like building up. Shows you how weak that Aussie is. Yeah, there's the CAD yen. Again, prof, you know, if you hit your target early in the week, you're supposed to take your profit. Yeah. Hey, Ryan, do you remember when you didn't even know what VIX was? Never even heard of it? Not, yeah. And now you're reading about it over the paper, eating your bacon and eggs with a shot of whiskey. Hey, honey, listen to this about a VIX. More bacon, darling. So anyways, yeah, get prepared. CAD yen, yeah, maybe. Kiwi yen, yeah, maybe. Look at the beast. I mean, we started on the beast. Let's end today on the beast. Putting all that in perspective, what if? I'm not saying it will happen. What if we have a big red bearish engulfing candle on the S&P 500 today? What are you going to do? Look at this beast, man. You know, it'd be redonkulous. What if the Bank of Japan raised interest rates or cut back its, I mean, it's not likely to raise interest rates, but cut back on QE or whatever? Don't be shocked, man, if all of a sudden we have yen strength. Well, I don't have an S&P 500 chart in front of me, but are we at like the all-time high again? Nick says pre-market prices are up. Uh-huh. Futures. Do you guys know what a pump and dump is? All right, so if you buy a futures contract, you're leveraged 40 to 1. So let's say you're a big hedge fund investor and you got millions, tens of millions, $100 million worth of stock you want to get out of. Well, you can't really get out of it unless there's buyers. Now, if you sell enough of it today, you're going to bring it down. You're going to actually create a red candle, which depresses your prices, which hurts you. So what you can do is go into the futures market, which is open, right? It's open right now, even though the stock market's not open. And all of a sudden, you can gobble up a whole bunch of S&P 500 futures. 40 to 1 leverage, pennies on the dollar. And you push the prices up. Pre-market prices are way up, huge green candles. And all the talking heads on TV, oh boy, market's bullish, market's bullish. Look at that, huge open. There's gonna be a huge open in the S&P 500. And all the dumb money goes crazy, right? And they're salivating because they want to buy. They want to buy the cash market. Get me in, get me in, get me in. The market opens, ding, 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 ding. And all of a sudden, people that bought those futures prices to push the market up, dump all their shares on the feeding frenzy. It's like throwing chum into the shark-infested waters. And you just unload onto these buyers. You just sell everything into the buyers, right? But meanwhile, you've made money on the S&P 500 because the futures went up. So you're getting out of your cash position and you're taking profit on your futures position. And maybe you don't get out of everything, but maybe you dump a third of your portfolio in a matter of the first 10 minutes of the stock market open. You dump 30 or $40 million. Plus, you had all these futures contracts you made a quick buck on. And by 10 o'clock in the morning, the market's down, not up. And who's all fat and happy now? And who bought those stocks? The rich dentist, you know. Merrill Lynch went in and bought it for their rich dentist. You know what I mean? So that's called a pump and dump. And by the way, the first video I ever saw banned on YouTube was Jim Cramer describing this on CNBC. I was flabbergasted. He totally went through one step by step by step by step how it's done. And I was amazed. So I watched it 2 or 3 times and then it was gone. So I searched around. 2 or 3 or 4 other people had it on their YouTube channels. So I watched it there. I'm like, there it is. And a couple of days later, it was gone on their channels. And I search, and all of a sudden, it's just not around anymore. Completely gone. And I'm like, what? How'd that happen? Yeah, no joke though. I'm like, what? You could see that CNBC would have sat down like, Jim, you're talking about like borderline illegal behavior, you know, manipulating the market. Like, it might not be fair for the average Joe. I mean, like, you can't say that. Did you guys see the one where, because I don't watch Jim Cramer. I don't have a problem with him. Some people hate him, but did you see it was early in the financial crisis where he absolutely totally freaks out? And I think it was like Ben Bernanke or somebody said, you know, that this isn't this is a subprime problem and it hasn't really moved into other markets. And Jim Cramer's freaking out, like he's absolutely lost it on camera. And they're trying to like segue, like he's being interviewed, you know, and they're trying to segue into something else. And he keeps freaking out. He's like, if, you know, he's like, call people, just call people. I've called people I know, they're freaking out. They're like, it's the end of the world. And, you know, he's like spitting, he's yelling so much. And he's like, it's the end of the world. It's like, it's crashing. He's like, oh my God, you know, absolutely totally freaking out that the market is just bloodbath gonna crash. And this is before it happened. Before you lost 50% of your net worth. Pretty amazing. So anyways, yeah, so he's the one that taught me about the pump and dump. So just because the futures are up doesn't mean it's going to go up. Right? So make sure you're the smart money. Make sure you're leading, not following. So, yeah, Nick remembers that. Cool. Wonder if it's out there. Do I dare look for it on YouTube? Jim Cramer freaked out. Yeah. Here it is.
Everything sort of starts out down a little bit, but
nothing to worry about. Boring summer fire. Almost, you know, today we haven't had a long time.
Just S&P says, ooh, we're worried about
Then all of a sudden S&P says, ooh, we're worried about bear.
Bear goes down, market goes down.
Bear goes down, market goes down.
Calm down,
then all of a sudden things kind of calm down, bear comes out.
Like,
Hey, we're okay, guys.
See, he's calm, right?
Bear goes back up to neutral, market's only down 20. Then bear comes out and says, oh, we're small, market's 22 years. And that's where we are right now, market's down 120. How do you trade this?
You gotta adopt a Henry Ford attitude here, which is never explain, never complain. Keep your mouth shut. Do that. Keep your mouth shut. Because you're going to say something that people don't like.
Say something and then we don't blame. And we say, hey, come on, guys, keep your mouth shut. Come out here and talk about your exposure. Speak softly and wait to that level and think the shorts have overdone the stock. And then you do what Dick Cole did in 1998. You pick up the phone to guys like me and you say, 32 bid, 1 million. And you get whacked. We come back to 31 bid.
Doing that inspires more fear. I don't want to create fear. I like Bear Stearns very much, but I think that at this stage, this is not a good call. They shouldn't have done it, and they should have just said, you know what, we're doing well, and don't say another thing. Just don't say it, because it does not inspire confidence to have 10 headlines coming over about what to do. I don't like it.
All right, I hear you. Now, I still, though, you know, when we said,
hey, look, the Dow can rally. We've seen the Dow rally.
No, I know. I'm not even, but I mean, it's just interesting, this bigger.
Well, this is about Bernanke. This is about Bernanke. He has to be on that call. Forget the.
By the way, I want to point out, did you notice the Dow is at 13,000? It ended up dropping by 50% since this video. Okay? Bear Stearns is still alive. Ben Bernanke is out there telling you everything's okay. By the way, I was probably selling my house around this time. I don't even know, right? But anyways, I just wanted to put it into context. The world was about to lose like $100 trillion, and nobody knew it yet, except a few people. And I just love how crazy he goes here.
Call. Forget the investors. The investors are going to do, if Bernanke
I'm
listens,
sure someone
Bernanke
from
needs
Bernanke's
to open the
office is on the
discount
call.
window. That's how bad things are out there. Bernanke needs to focus on this. Alan Greenspan told everyone to take a teaser rate and then raise the rate 17 times. And Bernanke is being an academic. It is no time to be an academic. It is time to get on the Bear Stearns call. Listen, open the darn Fed window. He has no idea how bad it is out there. He has no idea. He has no idea.
Kramer.
I have talked to the heads of almost every single one of these firms in the last 72 hours, and he has no idea what it's like out there. None! And Bill Poole has no idea what it's like out there. My people have been in this game for 25 years, and they are losing their jobs, and these firms are going to go out of business, and he's nuts. They're nuts. They know nothing.
Kramer.
I have not seen it like this since I went
imagine-
5 bid for 500,000 shares of Citigroup when I got hit in 1990. This is a different kind of market, and the Fed is asleep.
Okay, but here's the thing.
Bill Poole is ashamed. He's shameful.
Hold on. I know
He
you're
ought to
passionate
go
about
and
this,
read the
but hold on
accredited
for a
home
second.
document. At least I read the darn thing.
Hold on. I know you're passionate, and I hear you, but at the same time, a lot of people are saying this is, yes, there's certain types of mortgages that aren't available. There are all
can't get
sorts
a
of
darn
issues.
loan
But
if
to
you're
go out
rich
and
like
say,
me.
But Kramer, if he did what you said, which seems to me from the way
Cut
you
the
just
darn
explained
discount window.
yourself.
Cut the rate. Open the discount window.
Okay,
Cut the
but
rate.
if he comes
Relieve
out
the
next
pressure.
week and cuts rates,
Relieve the pressure.
you're going to have, that's going to cause Armageddon.
No, we have Armageddon. I wouldn't try to cause us that. We have Armageddon. In the fixed income markets, we have Armageddon.
No, but that's not what
We
they
have
say.
Armageddon.
They say, even when I've talked to a couple
If they
bank
cut
CEOs, they
the
don't say
rate-
it's Armageddon.
Well,
They say it's repricing. They're very firm about that
Oh,
even
great.
now.
Okay, well, let them be calm and then have them call me on the way home like they do every night and tell me, Kramer, what are you going to do about it? Are you going to help us? Are you going to help us? Are you going to stand on the sideline like everybody else and say that it's fine? Will somebody come on TV and tell the truth about how bad it
But
is?
a lot of people say, these same people say, it's not Ben Bernanke and the rate that matters. The bond market
That's
now
wrong.
is completely
It is the rate.
separate from
It's
the rate.
entirely
the
the
bond
rate.
market is trading
No, it's
separately from the
entirely
rate.
right. We'll spend billions in Iraq to build homes. We are going to have thousands of people. We have thousands of people losing their homes right now. 14 million people took a mortgage in the last 3 years. 7 million of them took teaser rates or took piggyback rates. They will lose their homes. This is crazy.
Yes.
I am sorry to be upset about it, but you have to understand what they're saying to me off the record before I come in here every night and every day. And what I hear from these blowhard managers who act like, call someone for heaven's sake. Go call someone. I worked at fixed income at Goldman Sachs. This is not the time to be complacent.
All right.
I mean,
That's your
darn, sometimes I
opinion.
wish I didn't know anybody so I could just sit here and say, you know what? Just go buy some Washington Mutual and take that yield. Unfortunately, I know too many people and I'm too darn old.
You are 62.
I've just been around for too long. I mean, look, I got to tell you, he has got to listen to, he's got to call somebody. Bernanke has to call someone.
He is.
He just has to call.
I can't.
Amazing though, huh? So I don't know, see if you can find the pump and dump video, but that one's actually just disappeared off the face of the earth. But you know, again, put that into perspective. Do you remember all the idiots that tell you that the market was that no one saw it coming? Here's someone freaking out where he's like, the head of the Federal Reserve hasn't even picked up the phone and called any hedge fund managers or any major banks to find out how bad it really is. And he's like, it's obvious. This is the end of the world. He just said 7 million people are going to lose their homes. On live TV, he's like, it's basic fact. Meanwhile, I sold my house at the top, and I took my wife, my toddler, and my infant child, and I moved to the other side of the United States, sold all my assets I possibly could, and hunkered down and prepared. And I was 6 months early. It wasn't impossible to see it was coming. Nick, it's beautiful here, and it's cheap compared to California. So anyway, so we hunkered down and prepared for the worst. And I was 6 months early. not so on selling house, because remember the housing market crashed first, right? So we sold at the top of the market, and then moved to Atlanta, and we were already in Atlanta by the time the Fed cut interest rates for the first time. So I had just moved when Kramer was doing this interview. So I don't know, it was predictable, it was obvious, and I don't buy the fact that